Hello, welcome to Open News. Please comment, like, subscribe. The Federal Reserve expects to cut rates more slowly in 2025. Here's what that could mean for you. According to the New York AP, the Federal Reserve's third interest rate cut of the year will likely have consequences for debt, savings, auto loans, mortgages, and other form of borrowing by consumers and businesses. But with inflation, pressure still elevated with the concern that President-elect Donald Trump's policies could fuel inflation. The Fed indicated Wednesday that it's likely to cut more rates more generally in 2025 than it had projected 3 months ago. The policymakers new envision 2 rate cuts next year, not 4 they predicted back in September. The result is that borrowers who have been hoping for a much lower rate loans could be disappointed. Loan rates may barely budge if the Fed sticks with its plan to cut its key short-term rate only twice next year. This could be the last cut for a while, said Jacob Channel, senior economist for LendingTree, because the upcoming Trump administration's policies might cause a resurgence in inflation or otherwise throw the economy off balance. The Fed might choose to take a wait-and-see approach and hold rates steady at their January meeting. Depending on the specific proposal the Trump administration manages to enact, the Fed could hold off on any additional cuts until March or even later. A gradual pace of cut rates won't mean much to people with credit card debt. Another rate cut is welcome news at the end of a chaotic year, but it ultimately doesn't amount to much for those with debt, said Matt Schultz, chief credit analyst at LendingTree. A quarter-point reduction may knock $1 or $2 off of your monthly debt payment. It certainly doesn't change the fact that the best thing cardholders can do in 2025 is to take matters into their own hands when it comes to high interest rates. The average annual percentage rate on a new credit card, according to LendingTree, is 24.43%. In September, it was 24.92%. Further modest declines in the rate, Schultz said, are possible in the next few months. But he cautioned anyone expecting card rates to go from awful to amazing overnight because of the Fed is going to be poorly disappointed. Elizabeth Renter, senior economist at NerdWallet, said that the particular credit card user who carries debt from month to month, it's a drop in the bucket for anyone feeling pressure from high rates. Let's see. So people with high yield savings account remain a good option. For savers, returns on high yield accounts have dropped as well, in tandem with the Fed's rate cuts. So while the accounts are not quite as attractive as they had been, they still might be worth investing if you haven't shopped for one recently. Some of these accounts offer yields at or near 5%. Yes, you've missed the peak rate seen a few months ago, Schultz said, but even at these levels, they are still likely higher than what you would find in a traditional bank. Let's see. Will mortgage rates ease? Possibly. The Fed doesn't set the mortgage rates. It does influence them. Long-term mortgage rates generally track the yield on the 10-year Treasury note, which in turn is driven in part by the market's outlook for inflation and the Fed's benchmark rates. That means that at least indirectly, cuts to the Fed's key rate can put downward pressure on mortgage rates even if they don't move in lockstep. Case in point, turmoil in the bond market has caused mortgage rates to yo-yo up and down over the last month, Channel said. After peaking at 6.84% for the week ending November 21st. The average rate on a 30-year fixed-year mortgage has since come down to 6.6%. Despite this decline, the average remains well above the 2024 low of 6.08% back in late September. For people with fixed mortgages, the rates won't change unless they refinance their mortgages or sell and move someplace else. Auto loans reflect lower rates. The effects of the Fed's half-point rate cut in September and its quarter-point cut in November have largely passed through to auto loans, which fell on an average from a peak of 7.3 in July to 6.8 last month, said Dan Ivy-Dury, director of insight for Edmunds.com. The half-point drop, he said, has helped more people afford new vehicles, helping to spur a buying spree in September. But the increased demand, which Dury attributed largely to some optimism over Trump's election, also boosted average prices and monthly payments to record levels. Optimism and having money on hand to do things that has definitely greenlit some people spending when other folks are more conservative on how much they like spending, he said. The average amount that a car buyer finances rose to $42,106, and an average monthly payment hit $753. That's the average, according to Edmunds data. Edmunds expects only a modest interest in auto sales next week, from just under 16 million vehicles this year to 16.2 million in 2025. Let's see. So the Fed will closely monitor inflation and the job market. That's what they always say. I'm almost wondering if they are going to say this now, and that way they can hold off on interest rates and kind of, because let's admit it, the Fed is part of the swamp, and I hate to use that phrase, but it is, and it's not, they're not interested in seeing Trump's next term go well. Here we go. So the Federal Open Market Committee is in a balancing act. Cut rates too much and risk inflation resurgence. Cut too little and continue to squeeze the labor market, said Renter of NerdWallet. Gregory Dacko, chief economist of EY, suggested that the Fed chair, Jeremy Powell, is reiterating the familiar metaphor of moving slowly in a dark room full of objects to justify a potential rate cut. Skip at the January meeting. This will favor a gradually easing of policy to observe how the economy inflation behaves, indicating an extremely data-dependent approach, Dacko says. That's just code to saying we're going to do what we want to do. A more gradual reduction of rates isn't guaranteed, and it probably won't happen. The AP says, remember, Channel said that Fed is designed to pivot relatively quickly should something unexpected happen. If the economy shows serious signs of deterioration, we could see bigger and more frequent cuts over the next 12 months. On the other hand, he cautioned, if inflation rears its head and spikes once more, rate cuts might be moved off of the table. Well, there it is. So we'll see. Thank you for watching the video. Please like, subscribe, and comment. But basically, that was a whole lot of nothing. I'm going to expect the Fed to do what the Fed always does, and that's what's in their best interest. Awesome. Well, I think you have a wonderful day.